Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz or at Banking Day. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 32 in our series for 2024, and today's date is Friday, September the 6th. First, I'll be talking to Evan Thornley, the co-founder and executive chair of LongView, the fund that allows property investors to invest in a slice of the more lucrative, better performing family home market without either the hassle of being a landlord or owning the entire property outright. And I'll be talking to economist Nicholas Gruen about how central banks around the world, including our Reserve Bank of Australia, can make better economic forecasts. But first, let's talk to Evan Thornley.
Evan, tell us about LongView.
Yeah, look, LongView is a 9-year-old business that's been cutting down the jungle of residential property for a decade and trying to understand why nobody's made much sense of it. And if I can give you a quick summary of that, every property market in the world is a trade-off between capital growth and rental yield. Turns out Australian residential property is close to the best capital growth market in the world, which means as a matter of mathematical certainty, it's one of the worst rental yield markets in the world. And yet people keep putting a focus on rental yield when they're making residential property investments. And to me, that makes no sense. You've got to focus on capital growth because that's where the money is. I mean, let's put this in context. The capital growth on Australian residential property, just the growth, not the underlying 10.7 trillion in asset value, but just the capital growth this year and pretty much every other year will be roughly the same size as the entire federal government budget, right? $680 billion, roughly 4 times the size of all the earnings of every company on the ASX combined. So the biggest wealth engine in the country by the length of the straight is capital growth on residential property. And yet there is no way to participate in that other than being a homeowner or a landlord. And so spent 9 years trying to understand why there are no investment grade products to allow you to get exposure to that underlying stable, high quality growth engine. And I think we've understood why that hasn't happened and what needs to happen differently. So LongView has essentially created an investment platform to invest in home equity as an asset class. So we're equity investors, we're not debt providers, we're not lenders, we're not in the mortgage value chain. We're about investing in properties that are going to have good capital growth and giving investors access to and exposure to a diversified portfolio of high capital growth properties. That's what the LongView funds are. And the first mechanism that we've done to do that is a little unusual, but becoming much more common, which is to co-invest with homeowners and home buyers. So we give them a portion of the equity in their home and they give us a share of the capital growth. And so that allows our investors to but we only do that on properties which we think are highly likely to get very strong capital growth. And so that effectively gives the investors access to high capital growth properties in a diversified portfolio across Sydney, Melbourne and Brisbane. Quality assets, these are all quality family homes, typically in the $1 to $4 million range. And then a multiplier against that capital growth, because the exchange for the homeowner or home buyer is typically we give them equity equivalent to roughly 10% of the value of the home and they give us a third of the upside. So the investors only make $1 if the homeowner makes $2. So the interests are aligned, but that effectively gives the investors, it's like a levered exposure to capital growth, but with no debt. So that means we should be in a position to deliver investors somewhere in the range of 1.7 to 2.1 times the house price index on an unlevered basis net of fees. So we think that's a pretty attractive way to get exposure to the asset class. And in another part of our business where we're the top ranked rental property manager in the country, we manage about 4,000 rental properties. We see all the challenges that landlords have in being landlords, which starts with they buy the wrong assets, but with all the other hassles, costs and taxes of being a landlord. And so we created these investment vehicles to give you all the benefits of being a property investor without any of those hassles. In fact, the irony is most of our landlords have made a better return on their investment in the family home that they bought for lifestyle reasons than in the investment property that they thought they were buying to make money. So we're saying, well, let's replicate that. Let's do more of that. You've made great money in your own home, co-invest with other homeowners and leverage the same quality of assets in a quite clever structure. So that's essentially what we're doing.
So tell me about this property investment vehicle that you have for landlords. I mean, what mechanisms do you use for them?
Yeah, so it's a unit trust structure, and that unit trust, we're the first fund, the LongView Homes Investment Fund, will invest in 200 quality family homes across Sydney, Melbourne, and Brisbane in the $1 to $4 million range, using the type of mechanism that I outlined, where we co-invest with the homeowner or home buyer in exchange for a share of their capital growth. And so across that portfolio of 200 homes, a certain portion of people sell their home every year and or buy out the fund's interest. And so that generates strong cash flow from the fund from probably year 3 onwards. Similar funds in the US have seen very strong cash flows. So you're effectively got a self-harvesting portfolio of high capital growth properties. And because of the diversification across the portfolio and the fact that a certain proportion of that portfolio will sell or buy you out every year, it actually drives much stronger cash flows than you would get by being just a direct property owner.
So what level should investors start at? Sort of 100K?
Yeah, so look, our minimum is 100K, which is interesting, right? Like when I talk to our landlord clients and I say, wouldn't you rather invest in quality family homes than, crappy investment apartments? They go, well, sure, but I don't necessarily have the capacity for many of them, certainly not a diversified portfolio. But obviously in a unit trust structure, we have a minimum, it's wholesale investors only at this stage, but a minimum starting position of $100,000. So, most people can find that more accessible than actually even a single investment property or a single additional investment property if they already have some.
So potentially you could have a whole string of investors having many, many different properties.
That's the whole plan. Yeah. Once you separate the physical ownership of the assets from the financial flows, you open up degrees of freedom for everybody to get a better outcome. And, and that's what all managed funds do. It's just remarkable to me that there is really no managed fund environment in the quality family homes of Sydney, Melbourne, and Brisbane.
That's quite extraordinary.
It's remarkable, right? Like half of all the wealth in this country has been created by levered equity returns on residential property, and the other half of all the wealth in this country has been created by every other asset class combined. And yet there is historically no easy way to access the former except by being a homeowner or a landlord. And so we're trying to make that much more accessible.
That's quite a niche.
I don't think it's a niche, Leon. The entire managed funds industry in this country has roughly $1 trillion in it. The landlords of Australia have roughly $2.2 trillion invested in this asset class, most of it badly. So we're starting to find landlords looking at investing through a fund as well as, or in addition to, or instead of direct investment property ownership. And they've got $2.2 trillion of footloose capital available. So over time, I think you'll find that's not a niche. And where you see these types of structures in other parts of the world, they've grown very quickly and very successfully. And ironically, this is a better capital growth market than almost anywhere else.
Well, being a landlord has a whole heap of issues.
Well, and no one knows that better than us, right? We started 9 years ago trying to fix rental property management because it's done so badly by real estate sales agents. We don't sell properties. We manage 4,000 properties. We just got voted the best large property manager in the country out of 47,000 licensed real estate agents. So I think if anybody knows the challenges that landlords have and the best you can do to try and address those challenges, it's LongView. But our view is, with everything we've seen in the last 9 years across all of our landlords, there is potentially a better way to invest in this asset class, and that's why we created this fund.
I have to ask you, do you actually work with real estate agents and mortgage brokers?
Sure. Yeah. I mean, we announced recently a big partnership with AFG where we'll be making our equity co-investment available to home buyers through their broker network. A bunch of, sales agents have got landlords who are selling property but who like the asset class, who could potentially invest in our funds. So we don't compete with them. We don't sell property. That's not what we do. We invest in property. So we have good partnerships across the various parts of the value chain in resi property.
And what you do is you create partnerships.
Yeah. We're creating new money. So we're not eating anyone's lunch in the industry value chain. We're creating new opportunities for mortgage brokers and their clients and new opportunities for sales agents and their clients. And really what we're doing is helping the real estate sector claw back some of the money it would otherwise lose to the managed funds sector.
And help them grow their business.
Yeah.
Well, Evan, thank you very much for your time.
Thanks very much, Leon.
And now let's talk to economist Nicholas Gruen.
Well, Nicholas, what was your response to RBA Deputy Governor Andrew House's speech about false profits?
Well, Andrew Hauser is a new Deputy Secretary at the Reserve Bank. He comes from my favourite central bank in all the world, the Bank of England, where they have used their independence pretty constructively to be quite critical of the way the banking system works. This was all through the global financial crisis. Andrew Hauser gave a speech in Brisbane last Monday arguing that economists, like most other professions, suffer from overconfidence. They think they know more than they do. And he got a little bit of stick for saying that lots of Australian commentators think they are way too confident that their own criticisms of the Reserve Bank's forecasting were correct. And that was a good message for him to give, even though it wasn't appreciated in some circles.
But you've argued that central banks should take a super forecasting approach.
Yeah, that's right. A super forecasting is an expression of Philip Tetlock's, and Philip Tetlock has done a lot of work on forecasting in the last 20 years, basically, and he's looked at this question of overconfidence, and he's looked at the question. He's not been particularly focused on economists, but his focus on forecasting generally has left him pretty unimpressed with economists. So working in the area of intelligence, particularly foreign intelligence, he asked forecasters to be very specific about what they were forecasting and the confidence they had in those forecasts. And he showed that professionals add very little value, or roughly on average no value, to the forecasts of informed lay people. And the exception to that was that there were some who he called foxes, and foxes take into account many things, and they try to ask themselves where they might be wrong, what they can learn, and they come up with a much better calibration of how much confidence they should have. So this is something that is applicable, incredibly applicable to economics, but the economics profession and central banks will not take the message. And Philip Tetlock went on from this work to ask himself the question, can we train people to forecast better? And if so, what does that look like? Can we identify people who are very much better at forecasting, and can we learn from them? And the answer was, yes, we can. And so the way Philip Tetlock identified what he called super forecasters was to have open forecasting competitions. And just like a market where people get rich, in an open forecasting competition, somebody who's consistently better than other people will emerge as the winner of the forecasting competition. So Andrew Hauser had diagnosed a major problem, and then more or less says, well, trust us, we're doing our best at the central bank. And I've spent the last year or so publishing columns arguing that if they want to get serious about this, they need to listen to what Philip Tetlock's saying and hold super forecasting competitions. Now, we can all imagine why they might not want to do that, because they lose control of the forecasts, because they effectively, instead of providing the forecasts themselves, they're creating an environment in which the best possible forecasts can emerge.
But you're saying central banks should actually adopt that approach.
I'm saying central banks should adopt that approach. And one of the questions is, so what's different about these super forecasters? Now, the way economists think about their technical education. They have debates about the latest techniques. But what distinguishes super forecasters is not that they know the latest techniques. I'll read, now Philip Tetlock is a psychologist, and he's interested in the psychological makeup of a super forecaster. I'll give you a list of some of super forecasters' qualities. They're open-minded, they're careful, they're curious, and above all, self-critical. They're after constant objective feedback on reality, how the world is developing, and how others see the same thing, and how much faith we should have in them. Now, they don't teach you any of that in forecasting at university. They don't discuss it. in economics journals, and they don't discuss it much in central banks. So that's what we have to somehow get economists to listen to and to do something about it. And a much better way of doing things is available, but it involves the bank understanding that it's not the oracle, it's the architecture of a better debate and getting better answers from better people, most of whom won't be in the bank.
Which is why central banks are having such difficulty forecasting the future of inflation.
Yeah, well, that's a different question in the sense that I'm not telling you that if you do all this, you will suddenly know the future. I think it was Niels Bohr who said that prediction's always difficult, but particularly about the future. So that's kind of to be assumed. So if we do this, one thing about forecasting will improve dramatically, and that is we will understand, like we do with weather forecasting, we will understand how much confidence we should have in our forecasts, because that's one of the things that the super forecasters will assess. Whether it will give us much more powerful insight into the future, the actual, whether inflation will turn out to over or undershoot, we don't know. But what we will know is how much confidence we should have, in exactly the same way that when the weather forecaster tells us it will rain tomorrow, they never just tell us that. They tell us the confidence we should have in their forecast. They say there's a 70% chance of rain. So those are the kinds of things we can be sure we will gain from that process. And I think it will help us get a little bit further in understanding how the future will turn out.
I'd imagine this would avoid groupthink.
Yes, exactly. So one of the huge problems, and it's kind of, human beings are groupish things. We like agreeing with each other as much as you might disbelieve that if you look at social media. But this is particularly bad in organizations. It's particularly bad in hierarchical organizations because lots of people want to sniff out what the smart money's thinking, and it's not really the smart money, it's the powerful money, it's what the higher ups are thinking. It's one of the reasons why Warren Buffett doesn't really believe in doing business cases, because he thinks middle management will sniff out what senior management wants and will try to provide that. That's groupthink. It should be regarded as a kind of mortal enemy of rational thought inside pretty much all organizations, and an additional benefit of something like an open forecasting competition and trying to empower the super forecasters among us is that it actually provides a robust mechanism for breaking through groupthink by providing advantages, career advantages, to those who are prepared to do that.
Well, the fact that Andrew Houser from the Bank of England is talking about these false prophets and he's tapping into this super forecasting issue.
Yes, let's hope so. Let's hope that's the next stage. But he's only the deputy secretary. He's only the deputy governor. It would be nice if the governor came out with a world-beating, brand new policy. Every central bank in the world won't go anywhere near this, and it would improve things. So they've got the independence. They don't need to ask anyone's permission. So let's see a bit of real independence.
Well, the good part is that Andrew Houser comes from the Bank of England.
Indeed. The best, well, I don't know whether it is now, but when I last looked at it, and Andy Haldane was the chief economist, it was my favorite central bank in the world. Fiercely independent of thought, not just of producing nasty interest rate settings.
Well, we'll look forward to seeing whether this is actually adopted.
Well, there's no sign of that. I don't want to do Andrew Houser's career any harm.
Okay. Well, Nicholas, thank you so much for your time.
Thanks, Leon.
So what's happening in the news? Well, Australia's economy fared better than expected in the June quarter, as government spending fueled growth. On a per capita basis, though, activity shrank for a record 6th quarter in a row. Gross domestic product grew 1% compared with the June quarter of 2023, the Australian Bureau of Statistics said on Wednesday. That rate compared with 0.9% predicted by economists and 1.1% previously reported by the ABS for the March quarter. On a quarterly basis, the economy grew 0.2% in line with forecasts by economists and the ABS's revised outcome for the March quarter growth. Australia's swelling population has masked some of the pain caused by 13 interest rate rises by the Reserve Bank in the past 28 months. Per capita GDP contracted 0.4% in the June quarter, extending a record retreat that began at the start of 2023 in data that goes back to 1973. June quarter growth would have been weaker without an increase in spending by federal, state and local governments. That extra demand shored up ongoing strong employment growth, but it also makes near-term interest rate cuts less likely. And health department officials have conceded that private hospitals are uninvestable and more will close. Labor MPs are increasingly concerned that the government is failing to fix a funding crisis that threatens to spill into the public system. The preliminary findings of a review ordered into a growing crisis within the healthcare system by Health Minister Mark Butler warn that private hospitals will close in the next 12 months. The findings also say a shift from overnight stays to same-day procedures is harming profit margins. The findings, which have not been released publicly, note that private hospital closures will put more pressure on public hospitals. Decline in investability of the sector risks the contribution it and the hospital sector as a whole makes to meeting health needs, documents summarising the review circulated by health department officials read. While there is substantial variability in earnings, profitability of the sector has declined over recent years. Average returns in the hospital sample may not support continued investment, the review, led by Health Department Secretary Blair Comley, finds. The concerns raised by the review are similar to those from major private hospital operators, such as Ramsay Health Care, which said on Friday that it could not build new facilities because the returns were not high enough. The pressure building on the health system comes amid an increasingly bitter stoush between private hospitals and insurers over who should shoulder rapidly increasing medical costs. Private hospital providers say profitability has swung too far to insurers. Insurers say private hospitals need to operate more efficiently. The outcome of that dispute and Labor's review will most affect the 12 million people who are covered by private health insurance. Their fees are regulated by the government, with increases approved once a year. And this would explain why private hospital investors have shifted away from new health projects following a surge in construction costs and collapse in profits, according to building industry figures. Silverstone Development's managing director, Troy Daffy, said a sharp rise in building costs combined with a collapse in yields following interest rate hikes had eviscerated the feasibility of building private hospitals. The builder, who has developed 3 projects in the health space, said Australian property funds and wealth sovereign funds, both of which were heavy investors in private hospitals until a few years ago, had abandoned the sector. There's no appetite for private developers or builders to build these things anymore, Mr Daffy said. This was evidenced by the collapsed proposal for a 12-storey health centre on Annerley Road in Brisbane's Woolloongabba, which highlighted the lack of support for new private facilities. Mr Daffy said the construction crunch was particularly acute in Queensland, where the government's enormous investment in state infrastructure, including public hospitals, had drained the workforce from the private sector and increased building costs. His company is currently developing a private health facility in Brisbane's inner city suburb of Spring Hill, but he said the massive flip in market conditions would have made the project unviable if it was beginning today. The construction price would be 40% more, but the valuation would be 30% less, Mr Daffy said. Brenton McEwen, General Manager of Healthcare and major real estate and infrastructure group Dexus, called for an overhaul of the private treatment sector to ensure health funding remains sustainable. The company, which has $12 billion worth of hospital and health centres under management, said ageing private facilities were inefficient and needed to be closed. While this might be a short-term fix, we need to think long-term, Mr McEwen said. We envision the future of Australian healthcare through the development of multi-purpose real assets within precincts that offer a mix of treatment, care, prevention and research facilities. These intermediate care facilities could reduce costs by 30 to 40% compared to a traditional hospital stay of 4 days. And REA Group is considering a takeover of Rightmove, the United Kingdom's largest property platform, in a deal that could cost more than $9 billion and transform the ASX-listed News Corporation-backed real estate giant into a global player. REA told investors on Monday it was considering a possible cash and share offer for the entire issued and to be issued share capital of Rightmove, citing clear similarities between REA and Rightmove that would allow it to build a global empire. REA's possible £5 billion plus move on Rightmove, therefore, has something for everyone. Murdoch watchers can wonder if it means that Lachlan, the chosen one, is keener on property websites than newspapers. And is the medium-term destiny of News Corp to be split in two, liberating the 61% owned REA and other property-based operations from the media assets, as one US activist fund called for last year? Rightmove was founded in 2000 by 4 real estate agencies and listed on the London Stock Exchange in 2006. It is worth £4.4 billion, that's 8.5 billion Aussie. REA, founded in 1995, is one of the ASX's 20 largest listings, with a market capitalisation of $27.3 billion. But the two companies' fortunes have been very different over the past year. REA has grown more than 25%, while Rightmove has fallen 1%. The expansion could be a risky one, with shares falling as much as 7% on investor concerns before closing 5.5% lower. Some of Australia's largest companies have come unstuck in the UK, including Wesfarmers, with its failed 2016 purchase of hardware chain Homebase for $705 million. It exited that investment in 2018. Lendlease has also dramatically scaled back its international ambitions and will leave the UK next year, while AMP tried and failed to expand into the region in the 2000s. Despite being the market leader in a country of 66 million people, more than double Australia's population, Rightmove last year posted revenue of £364.3 million, that's 706 million Aussie, against REA's $1.35 billion. Rightmove is more profitable. It reported £264.6 million compared to REA's $461 million. Morningstar analyst Roy Van Keulen, who covers classifieds businesses, said this could be seen as a defensive move by REA to ward off a future international competitor. US property data giant CoStar bought third-place residential listing platform On the Market for $99 million, that's $192 million US, in December, a bid that initially sent Rightmove's share price tumbling 14%. If you are REA, you've got to think 10 years ahead, Dr. Van Keulen said. Running ahead from number 3 position is harder than running from number 1 position. REA's chairman is Hamish McLennan, a Murdoch family lieutenant who has held several other prominent board positions. And AirTrunk founder Robin Cooter has cemented his billionaire status after clinching the sale of his 9-year-old data centre business to Blackstone in a deal valuing the company at $23.5 billion, which highlights the wealth created by the artificial intelligence boom. Founded in Australia in 2015, AirTrunk opened Australia's first and largest hyperscale data centres in 2017. It now operates a platform of hyperscale data centres across the Asia-Pacific and Japan region. Blackstone, the New York-headquartered asset management giant, beat a consortium led by industry superannuation fund money manager IFM Investor to buy AirTrunk from Mr. Cooter and Macquarie. Mr. Cooter will take home $500 million in cash and retain a stake in AirTrunk of about the same value. He will remain as chief executive. The businessman, who arrived in Australia from Bangladesh to attend university when he was 18, sold 88% of the company to Macquarie's infrastructure arm and Canada's PSP investments at the start of 2020. He kept a 10% share of the business. After yesterday's sale, Mr. Cooter's stake in AirTrunk has been reduced to 5% and is worth about $500 million after the company's debt is factored in, sources close to the transaction said. Macquarie's fund and PSP will sell their AirTrunk stakes in full. The deal triggers a large performance fee for ASX-listed Macquarie Group, which manages the fund. The fee is expected to be worth hundreds of millions of dollars. The deal is easily the biggest corporate transaction in Australia this year, and the 5th largest ever, after Block paid $39 billion for Buy Now Pay Later Group Afterpay in 2021, the $33 billion sale of Westfield to Unibail Rodamco in 2018, the $32 billion acquisition of Sydney Airport by a consortium of superannuation investors in 2022, and the $26 billion merger of gold miners Newmont and Newcrest last year. And cash isn't the only thing in short supply at Star Entertainment. Time is also running out for newly installed Chief Executive Steve McCann to get a deal across the line. After being suspended for 3 days from the Australian Securities Exchange for failing to provide its accounts by last Friday, every hour Star remains banned from ASX trading, adds to the company's reputational damage and the urgency to secure an agreement. That will be no easy feat. The New South Wales and New Queensland governments are at odds over whether they will deliver tax relief. The bank syndicate, while open to a deal, is demanding extra security before it advances any more cash, all of which has to be ticked off by regulators and auditors. Everyone is playing chicken, raising the odds on a high-stakes game of chance. Once perceived as a glittering symbol of city sophistication, Australia's biggest listed casino group has found itself reduced to the status of last chance saloon. McCann, who's been in the job just a matter of weeks, has made it clear to all that he's not interested in putting a stopgap measure in place, that the deal he's proposing will need to shore up the company's finances for the long term. By all accounts, the former Lendlease chief executive was stunned to discover shortly after arriving that Star's finances had been drained by a huge cost blowout at its new Brisbane casino development on the river at Queen's Wharf. The massive development cost almost twice as much as anticipated, and while it technically opened last Thursday, it remains a cash drain, given the facility is less than 20% leased, with work continuing on retail sectors, and the ultra-rich are buying up big and using shell companies to hide it. They are increasingly hiding behind corporate entities and trusts as they snap up high-end properties. Of the 50 most expensive properties sold last year, almost a quarter were acquired this way. In 2018, this figure was only 12%. Piercing the secrecy of these companies shows a growing industry, from buyers' agents to lawyers, accountants and realtors, devoted to obscuring the true owners of high-end property. David Morrell, a buyer's agent who specialises in prestige Melbourne property, says the wealthy are increasingly creating schemes to shield their real estate transactions from view, although he adds that this is largely not for any nefarious reasons. These very wealthy people, the wealthier they are, the more they value their privacy, Morrell says. Privacy is the main driver, but I'm sure there is a seedier side. I'm seeing more and more people using a company vehicle to purchase properties. And along Sydney Harbour, from Circular Quay to Barangaroo, a slew of apartments in the Crown Residences, Bennelong Apartments, Macquarie Apartments and Opera Residences are held by shell companies, vehicles that lawfully hide the identity of their owners. The easiest way to keep a property purchase away from private eyes is to put it in someone else's name. Nicole Kidman, for instance, owns a 3-bedroom apartment in Latitude, a Milsons Point apartment block, which she purchased for $7.7 million last year. The property, however, was bought in the name of the Hollywood actress's childhood friend, Anit Reshner. A more complicated approach is to use a shell company, often linked to a trust. And in what will be disappointing news for first home buyers, Australian house prices have continued to rise over the past month, according to new data. Average dwelling values climbed by 0.5% in August, the 19th consecutive monthly increase in house prices tracked by CoreLogic's Home Value Index. The median value home is now worth $802,357, jumping from $798,207 in July, but the findings indicate the pace of growth in the real estate market is showing signs of slowing. Australia's capital cities were evenly split on house price rises and falls, a symptom of what CoreLogic has described as a multi-speed market. Parts of the country continue to see house prices rising, with Sydney 0.3%, Brisbane 1.1%, Adelaide 1.4% and Perth 2%, increasing over the month. On the other hand, there were declines in Melbourne, minus 0.2%, Hobart minus 0.1%, Darwin minus 0.2%, and Canberra minus 0.4% in August. Eliza Owen, the head of research at CoreLogic, said on a national level, house prices have been rising consecutively for more than a year, which was seemingly define the current economic climate. And the Greens have their eyes firmly fixed on winning over renters at the next election, with a new policy aimed at giving tenants more power in resolving disputes with their landlords. The Greens have announced plans to establish a National Renters Protection Authority, or NRPA, which would only deal with the tenancy disputes, including enforcing national minimum standards the party has put forward, covering ventilation, heating, cooling and insulation. Costed at $200 million a year by the Parliamentary Budget Office based on the Greens' rental policies, the NRPA is proposed to have 1,000 staff across the nation, allowing them to investigate rental breaches as well as offering advocacy, advice and education to renters all around the country. The Greens say investigators with the proposed body would be able to issue fines of up to $18,780 to real estate agencies found to have breached the rules, as well as on-the-spot fines of up to $3,756. The fines would increase for serial offenders. The agency would take the place of state and territory administrative tribunals, which are often overwhelmed with rental disputes, particularly over bond payments. And that's it for this week. And next week I'll be talking to Mustafa Nuristani, the Executive Director of the Transcendental Meditation Organisation Australia. He has taught TM to thousands of people, including business leaders, judges and doctors in Australia and abroad. And I'll talk to economist Saul Eslake about the state of the economy. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you can catch me on Facebook, Twitter, Instagram, LinkedIn and YouTube. And if you want, leave a comment. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Also, in my copious spare time, I have a copywriting business. If anyone needs newsletters, blogs, articles or editorial, email me. Wishing you all a safe and healthy week and looking forward to bringing you Talking Business next week.